All right, this is Ubaid on behalf of Electronics, and in this video, we'll talk about how the disruption in the exchange rate may cause a disruption in the financial capital investment. All right. Now, when it comes to financial capital may be used for a lot of different reasons. Okay, financial capital in the bank may be used by the bank to lend money out to individuals, such as households, as well as businesses. Okay, the more financial capital a bank has, the more money it can lend out. However, if the investors, let's say foreign investors, do decide to withdraw their money from the banks because of whatever expectations they have about the future, okay, it will lead to a reduced financial capital, okay, which may mean that the bank may be able to lend out less. It may also mean that the bank may be facing bankruptcy if it has already lent out a lot of money. Okay, so we've seen this back in the past, okay, back in 2007, 2008, where foreign investors invested money in subprime mortgages. And unfortunately, because the homeowners weren't able to afford the mortgage because of inaffordability, okay, the foreign investors lost their money when it came to subprime mortgages in the bank. Okay, this is a product that was offered by the bank, and the bank was able to offer this product because the foreign investor or investors invested in the bank. Okay, they brought money into the bank, which pumped up the excess reserves of the bank for the banks to lend out money as subprime mortgages. All right, now if for some reason the exchange rates go down, okay, let's say the investor expects the exchange rates to go down in the country where he or she makes an investment, okay, he or she will expect a reduced return on investment, okay, because if the exchange rate goes down, okay, what's going to end up happening is his financial capital will be reduced, okay, as a result of which he will receive less. All right, now this may slow down production because the bank is not able to lend out money to businesses. It may even slow down consumption because banks are not able to lend out money to individuals and households in the form of line of credit, personal loans, auto loans. Okay, or okay, we're dealing with banks here. And we know that banks do charge interest, okay, when it comes to borrowing money. All right, so say for example, okay, if a foreign investor, okay, such as a business was to invest in a certain bank, okay, let's say in the home country, let's say this is your home country, and a foreign investor decides to invest in the bank of your home country. Okay, and let's say this foreign investor, okay, decides to invest $200,000. All right, so the bank is basically borrowing $200,000, and let's say the interest rate is 5% on this $200,000. All right, now if you do the math, 5% of $200,000 will be $10,000. So this is $10,000 in interest. All right. Now, say for example, the exchange rate in this country where the bank is located is, let's say, $1.60, okay, of the foreign currency where the investor is located. Okay, so $1.60 per, let's say, euro. Okay, so €1 is $1.60, for example. All right, and this basically means that this amount over here, $200,000, okay, let's say this is 200,000 US dollars or Canadian dollars, okay, will be worth 125,000 euros. So 125K euros. And if you do the total over here, which covers the principal and the interest, this is 200,000 plus 10K, so 210,000. So 210,000 will be 131,250. 131,250. All right, and this is how much the bank will owe this financial capital investor. Okay, because obviously the bank has to pay interest. Okay, let's say the financial capital is in the savings account, and the bank has to pay 5% interest to this individual or business who is located in a foreign country. And so this will be euros. So 131,250 euros. Okay, this is if you consider the foreign exchange rates. Now, when the bank goes ahead and returns the investment, so let's say repays the obligation. Okay, let's say the exchange rate on that day, let's say a year from now, is $1.20, okay, euro per euro. All right, in this case, okay, your 131,250, okay, so 131,250 or $210,000, okay, will be worth $175,000 or 175,000 euros, excuse me, 175K euros. So 175K euros. All right. Now, because it's worth 175K euros, okay, it's worth more than what it was worth before, okay, which was 131,250 euros. So that's a total of 43,750 euros. 43,750 euros in difference. And this is what the bank pays as a loss because of the exchange rates. Okay, about 200,000, so 210,000 altogether. Okay, which the bank repays. And when the bank repays, instead of paying 131,250 euros, it ends up paying 175,000 euros. Okay, which is a loss of 43,750 euros. Okay, and again, this will be euros. All right, and because of this loss, the bank is not able to lend out as much money as it would be. Okay, so bank is able to lend out less. Bank is able to lend out less, is able to lend out less money. Okay, lend less money, less cash, less money. All right, so this would be to individuals or households as well as capitals. Okay, so we're talking about businesses. So households and businesses as capital investment. And because it lends out less money, the production is slow and the real GDP shrinks. Our GDP shrinks, which may lead to a recession. Okay, leading to a recession. So this is how the exchange rate disruption causes a disruption in the financial capital. And when it comes to the banks dealing with the financial capital, it may suffer a loss or a profit depending on whether the exchange rates go up or down, whether the exchange rates appreciate or depreciate in value. All right, so that will be it on behalf of V Electronics. This is Obeid. Have yourself a great day.